Thursday, the September 4th, we've got ADP non-farm payroll change in a minute. You can see here on the graph. We've also got weekly claims. We got services PMIs out of the US. Basically, we call it non-manufacturing employment, and PMI data is from the ISM later on. We also got Standard & Poor's reading as well, also this afternoon. So lots going on in the next hour or so. So hang fire, stay with us, and let's see how we go. The rally in gold continues. It's come off a bit. We've been stopped out because we had our stop loss rammed right up behind it, but we were up. We went from $3,371 to $3,528. That's an awful lot of pips, an awful lot of points. It's $156. Work out the pips and the points for yourself, but very profitable trade to the upside as we trailed the rally in gold over the last few days. Jolts yesterday was a bit disappointing, quite significantly disappointing. So let's go back to yesterday's data. The Jolts number, I wasn't around for that. We were live in the morning. So 7.18 million for the job openings. That's one of the weakest in about, I think, nearly a year. Yesterday in the UK, that's the US. Yesterday in the UK, the head of the Bank of England and the rest of his colleagues from the Bank of England were talking about likelihood of rate expectations of cuts from the UK seem to be slipping from his take of things. That was the take. Got much more hawkish tones from other members of the Bank of England. The politics in the UK is not helping either. We got the Deputy Prime Minister under pressure for some property deal or a property deal. The Treasury, the head of the Treasury, the financial secretary, if you like, in other countries, Rachel Reeves under pressure. The budget is about as late as it could possibly be. The 26th of November, the UK budget is coming out. That's about as late as it could possibly be, right at the end of November. Sign of potential pressure that she's under about whether she's going to have to, what sort of taxes she's going to have to raise in her budget. Defending herself all the time. Earlier in the week, we had the Prime Minister here in the UK beefing up his communications out of Number 10. So lots of political issues there. We've got political issues in France. We've got issues in Japan and health. The major run we've seen on the long end of the yield curve, 30-year yields, particularly France, UK, and Japan have been under immense pressure. We've had a big run up. It's globally as well, but particularly those countries, and that's had this knock-on effect to stock markets and currencies as well. We'll see what this jobs numbers look like now. Remember, the Fed has sort of tweaked its focus. It's got this obviously dual mandate for inflation and jobs. The story of the weakening jobs numbers from that non-farm payroll we saw on the 1st of August is sort of rippled out through August. But persistently, though, the weekly claims that we're going to see today have held up. So clearly, there's some sign of companies not hiring, and that's what that jolt, the number that's just come out this morning, what's actually on this calendar, the Challenger numbers. That's not on the the Mosquito is a one. Sorry, let's just do today. The numbers I was talking about, or trying to talk about, was the Challenger jobs changes, and it's not actually on here. So let's change the filter back to select all. Bear with me a second. Let me just refresh that. I did want to show you the Challenger job numbers for today. So we'll come back to
85,000. It's increased by 85,000, 13%.
Yeah. Much. The big miss. Where's it gone? Challenger.
To be honest, the Challengers, I wouldn't expect to increase by that much.
Yeah. 100% last month, 13% this month, another
Yeah,
13.
13% this month. The previous month it's a little bit less than more than previous months, but it shouldn't be actually in this way.
Yeah, and job cuts higher. Yeah, exactly. Yes. So we'll see. We'll see what this what the numbers look like. Obviously, everybody's focusing on Friday's, tomorrow's non-farm payroll data, which is looking like, say, last the first about 10 days ago when the first estimates started to come in for this month. It was around about 86,000. That's the average now. Is just do the rest of the week. Tomorrow, look at we're down to 75,000 for the um, payrolls numbers tomorrow. So non-farm payrolls, both the Bloomberg and the Reuters polls are both around this, or actually on at the moment. Last time I looked at both of them, they were both on 75,000. Some as low as 25,000. Some of the banks, there's quite a few around about 50,000, but the consensus is 75,000 for tomorrow. So this idea that the jobs area is weakening, but and recruitment's not happening, but people are losing jobs particularly. So they're not firing people; they're hanging on to the people they've got. They've got hit from the last from the COVID impact. So if that starts, we start seeing job losses, and the impact of the tariffs becomes more substantial, and the inflation becomes persistent, which it tends to be. I've been saying this for years, as long as anybody would listen to me. Inflation is sticky by its very nature. History has always shown us that. So this idea that the Fed was talking about is only transitory last time was proved incorrect. And this idea that this is a one-step conversion because of the tariff, the impact of the tariffs in the US. Again, how long these tariffs are going to be around, there could be, the way Trump talks about them, as them being fairly permanent and fairly substantial, and likely to go up rather than come down. So we'll see how it all pans out as far as the US work is concerned, and if the ripple down effect actually happens, and what we've seen is this potential massive asset bubble again. We've seen in past boom and bust cycles, and we could be a similar situation here. So, anyway, that's my opening take. Arura, I don't know if you got anything to add to that, or take away from that, or agree or
Yeah.
disagree.
About the inflation, since I mean, general the inflation. I was reading the beige book which published yesterday. I don't know if the guys they read that or not. The concerns about the inflation was not. I mean, in most of 12 distriction of the Federal Reserve, the inflation concerns it was not such a big concern. But when it comes to the inflation, and when we are looking not just in the United States, when we are looking at the Europe, the European inflation also published yesterday with the PPIs and CPI also earlier this week, we see that the inflation in the eurozone is low. But at the same time, if you look at the retail sales published so far today in eurozone, we can see that the retail sales is falling so much. So
Yeah.
when we are talking about the inflation is the combination of supply and the demand. The lower inflation in the eurozone is not because that the European Central Bank did very good job, and if the inflation is not so low in United States, the Federal Reserve didn't do a good job. The main reason of lower inflation in eurozone is because of lower demand. If you look at the manufacturing orders, if you look at the retail sales, if you these data, they can say that the main reason is because of the people they do not want to buy. The retail sales in the previous month in eurozone it was falling by 0.5%. While if you compare it with the United States, if you look at for example, yesterday we had this I forget the name of the 6.5% we had the retail sales data in the United States for the big wholesale supermarkets. So these data confirms that if in United States the inflation is still the concerns is because that the people they are still spending the money. So that's why the inflation is concerned. So in this
Yeah.
case, why I'm telling that, because I want to say that in this case inflation shouldn't be too much bad, because when there is a little bit of inflation, if you look at the Mr. Powell's conference on the speech in in Jackson Hole and the new system in United States and for Federal Reserve that you are not going to talk about that same thing that the European Central Bank did. They are not telling that the inflation should be at 2%. They are telling the inflation should be around 2%. So what means this around 2%? It means that for a long time we had a too long time inflation under 2% central bank target. So that's why it should be a little bit normal to have slightly inflation slightly above this central bank target, which is around 2.5% in the United States, which is not a big deal. I think that's even support the retail sales that support the. If you look at the durable goods orders, increased by 1.1%. The core durable goods orders increased by 1.1%. That's amazing. So that's why I think when we are talking about the inflation and the expectation of the tariffs effect on the inflation, we can see on the PPI side we don't see too much problem. In the in beige book, what we could see is that in a labor market, I should probably six regions they were talking about that after this new immigration law and the problems that happened with the immigration. Now they have, especially in New York and some other generally the 5 or 6 regions, they have a shortage in some construction side and a shortage for the labor in the construction business and stuff like that, which is like a little bit hard works. But generally, generally the situation and the improvement I think is fine. Even though the labor market with the 73,000, it's very low. We know that is lower when we are talking about the less than 100,000 newly created job. It's amazingly low. But when you're looking at for the challengers job cuts, yeah, 85,000, slightly bigger than previous month, but still for the U.S. economy, I don't think such a huge number. But at the same time,
And that's what people were saying about this. You know, the 75,000 we're expecting tomorrow mightn't be such a. You know, we've seen this even 6 months
yeah,
ago. It would have, the market would have kicked off. But I think we've ameliorated, and that's why the Fed have done this tilt away from this inflation, but with the caveat, which is why they didn't. The idea of them cutting this month is that virtually is nailed on, and we're around about a 50% chance of another cut in October. But if we just look at that ADP number, it's coming much weaker than expected at 54,000. Last month was upgraded by 2,000 to 106,000, but it's still, very low at the low end.
do you remember that in a
almost
previous, like in last almost 2 years, always this ADP, when we are missing the ADP, we are beating the NFP. When we are when we are
Well, that whole discussion is very much up
yeah
in the air now with the sacking of the head of the
yeah
BLS, the Bureau of Labor Statistics, and that big realignment of the non-farm payroll data. Very weak over the last 3 months.
I do
So
expect, to be honest, I do expect a better than expected. I mean, I do expect like more than 90,000 newly created job for the NFP. I'm waiting for the positive data for the labor market.
yeah. It's how much as you say, the immigration policy to migrate has actually had a squeeze on the people that are actually
Yeah.
reporting. And it's not the question of the data, or there's question marks over the data itself. But the ADP number notoriously drifted apart from that non-farm payroll a few years ago. I think 2 or 3 years ago, they realigned it. It was out offline. We didn't get any ADP data for 3 or 4 months. They brought it back in September, and it came quite. The alignment was okay, and then it's drifted again. But the ADP number seems to be more in tune with what the market is thinking. So it's coming missing at 54,000. The claims will be interesting in 10 minutes'
Yeah.
time. Not only the headline, which has remained remarkably stable around about this 230,000. It did go to 240, 245. But the one that I've been noticing is ticking up is the continuing claims. Those that have been looking for work for more than 4 weeks. That's 1.96 million expected from 1.945, and that was higher again last week as well. So again, let's have a look what that looks like in a few minutes. The initial reaction, as you might expect, this is the minute chart, guys, for the euro. The dollar weakened on as weakened in the first. I just got that's the data coming out here right on 13:15 here, 12:15 Universal Standard Time. So you can see we've with the dollar having been stronger all day, hit a new. Is that the daily? Yeah, it's round about its daily high, round about here 116.60. We've come back down to 116.50, 49, so we're under that 116.50 area. I'll just go back to the 5 minutes. It's fast enough for me. So that's our sort of high for the today for the euro. It's back here at 2:30 this morning, my time at 16.70, and we've been lower since low. So we'll see where that takes. So the dollar's been a bit stronger into this key data, but weakened on that day. So we'll see what the week agenda looks like in a minute, and it's the same for the other. Back one, back. It's 148.28 back at the moment. Dollar CAD, which we had some trades on, was taken out. One of our targets earlier, and Swissy, sorry, it's wrong one. CAD got a bit more. Yeah, that was a target from the other day. We got to the target, and we're back to stop loss up. We might have actually been taken out on that. I don't know whether that's been filled or not, but we've moved the stop loss up from our trade we've taken here. If we go to the time frame.
So while you're looking at this data, there is some the data there around, which is publishing in the past days. Wanted to ask your idea about that. When we are looking at the trade data, especially from the trade data is coming out, especially from the countries like China, Japan, Australia, New Zealand, South Korea, and United Kingdom, Germany, uh, even the other countries in Eurozone, most of them, when you're looking at them, either they're, I mean, the most of in most of them, I'm not talking about 100% of them, the export is falling very badly, while in some of those economies, the imports also going to the negative zone, while the export is falling shortly. Do you think this idea of less export in most of these economies means that we are going to have a very bad or not even the very bad. Do we have it going to have a second half of the year in a weaker general overall economic condition in the world? What do you think about these data?
I mean, we don't really know, but I'm rather positive, to be honest, for the second half of the year. I'm saying that I still have a caveat that the, the general public in the United States and the general business environment, the businesses seem to absorb the tariffs so far. That can only go on for so long. They front run inventories, they front run imports. People in the United States aren't changing their buying habits that quickly since February, since April, since the tariffs thing was announced. People are still wanting to buy these cheap things that come in from overseas. So at the moment, what we've seen so far is that it's just my take. Is that businesses have absorbed that, haven't really passed it on to the consumer. Hence, we've still got this weaker inflation. So as I said earlier, inflation is traditionally sticky, whether it's goods inflation, whether it's food inflation, energy inflation, or the more important, services inflation. Remember, it's the services inflation. What accountants can charge, what doctors can charge, what obviously you pay for everything in the United States, what your insurance level can be. So all of that is still building up, but there's still a lot of cash kicking around as well. On the flip side, but a lot of that is starting to get squeezed as well now. So it's that double-edged sword. I remember that as far as the stock markets are concerned, you know, it, most of America, Joe public is invested in the stock markets, but it's not. The majority is still owned by the top 1 or 2%. Still, the top 5% own a vast amount of stocks. The stock markets in the United States being driven by big tech companies. It's very good at the rate. Looked like we had a bit of a churn. Looked like we had a bit of broadening out. Didn't happen earlier in the year. A lot of money was leaving America to invest in better opportunities or bigger returns in places like Europe and parts of Asia, or even Latin America. But yeah, I mean, so it's very much a mixed picture still, and so that we remain quite cautious with regards to what is the new normal, where normalisation is. But certainly, the, I heard somebody say earlier in the week about the rate cut not next week, but on the 17th from the Fed looks to me more like a political rate cut than a technical, economic rate cut. The pressure has built so much that the caught, the danger of getting caught out, being late again, which many have said still are. So that is happening. So is that a one and done for the year? As I say, with the October one, if you look at the October, as far as where the money on the table is still, if we look at obviously it's the free.
For October, there is even the chance of even 6% chance of rate hike.
That's what I was
Yeah.
going to point out, because I mean, there's all the extreme views, and people just punting and gambling on that, and sometimes it's for notoriety more than anything. That's my that's not playing ball.
Yeah, but still, with looking at these data, when you're looking, yeah.
Yeah, 29.
Yeah.
It's like 50-50. Yeah, 54. But yeah, I mean, it's down to 1% now. But yeah.
Yeah, it was 6%. Like previous week, it was like previous week was 6% chance for rate hike in October.
Yeah.
Now after these data comes down. But however, about the rate hike being the political or not, we have 3 minutes till to have the initial jobless claims data. About being a political or not, I think it's not. I don't think it's going to be a political decision, because if the Federal Reserve wants to have 2 rate cuts this year, and if they didn't cut the rate in September, they're going to have only October and December. And in 2 meetings, the meetings right after each other, cutting the rates may put some shock on the economy. That's why probably I think it's economical decision. They're cutting the rates in September, and they will give it time to the market to see what is the market reaction, and most probably we are not going to have any rates cut in October. So the Fed going to cut the rates in September. That's why, to have more time to make a decision before December meeting. So that's what I'm thinking. So that's why probably they decided to cut the rates in September, to have more time to think for the second rate cut, should they have or shouldn't. But if we wanted to say about the political, probably the Fed was talking about the initial thoughts that maybe Fed goes for 50 basis point rates cut, but it was very crazy idea if they would do that. But still, yeah, there was the idea of the 50 basis point rate cut as well. But yeah, that's the situation, and that's what's going on there.
And I said the big claims numbers are about to drop as well. So again, this will be really interesting, because these weekly ones have held up and flown in the face of the monthly ADP non-farm payrolls, giving this argument that companies aren't firing, but we're not necessarily hiring in that challenger job cuts.
The challenger job cuts also compared with when you're looking at the annual numbers, the previous month it was 139, and this one is only 13%. So I mean,
it's a significant tick down. But again, it's the node. We've got the other thing we've got to remember. So we're just at the beginning of September. These are August numbers, so they're traditionally really bottom, really low. So there has been an uptick. The claims is coming at 237,000. I mean, it's not 240,000, not 245. Last week has remained the same. The 4-week average is at 231 now, and the continuing claims is actually coming better than expected.
Yeah.
At 1.94 million, so not as bad as many were expecting. Last week got ticked up as well. It actually came back down from 1.954 to 1.944. So again, a mixed picture here. So clearly not. Companies are still hanging on to workers. The issue also, obviously, within the claims is, as you say, the participation rate data tomorrow will be quite interesting as well, because the market has thinned out. The market seems to be, and this is what the Fed speaks to as well, as far as the US market is concerned. It seems to be getting to some sort of parity, some sort of balance with these jobs.
Well, Mr. Swart, we should take care also about water numbers. The unit labor cost is fell by what? Is decreased to 1% only, and at the same time, the non-farm productivity increased by 3.3%. So, combination of these numbers means that while this means while the cost of having a labor, while the cost of having someone to work in your company is decreasing, at the same time, the productivity is increasing. So that's very important to look at the fundamental. Look, that means that the inflation shouldn't be a concern. I mean, when you are paying less and you are getting more.
Comes back to something we talked about before about the impact of the immigration, kicking people out in their work base. It's been quite a significant, clearly implication there. As you say, as unit costs have come down significantly, and productivity therefore bounces significantly, you'd expect that sort of correlation. But both of them are better than the market was anticipating, so that's quite a significant hike in productivity. A significant decline, as you say, in unit labour costs. Absolutely, yeah. Trade balance more or less in line. It's 78.3, but again bigger than 77 was expected.
Again, with this data, I think the market participants they're gonna wait a little bit more till tomorrow. They will put their idea and their position on a hold most probably. If I want to make a decision right now, I wouldn't do that and would wait till tomorrow to have a better and clearer idea of what's going on here. I don't think that these data are going to affect the markets. Significantly.
No, but it doesn't see how what the dollar's done again there. See, the dollar's come back now. So it weakened on the ADP numbers. The weekly claims, which continue to hold up, has improved the outlook for the dollar on the immediate reaction. So this dollar strength today sort of continues. If you look at the hourly chart, I'll just reassess that. Yeah, so the dollars been on the front foot all the Asian session, and certainly through this European session and into the opening US trade. So downside here, technically here on the hourly, next downside is 116.20 and 116.20 is the next downside target there on that hourly chart. That spike we had yesterday morning took us to that 116.08, so within, as we said yesterday, within a few pips of 116. So 116 is perhaps calling more than 117 and 118 to the upside certainly for the rest of the day potentially. But we shall see. There's lots of data, lots of nuances still kicking around. Today also marks the Stephen Mirren, the guy that Trump wants to take at least a temporary position on the Fed. He came out, his confirmation hearing starts today. He came out this morning with a statement saying he supports the independence of the Federal Reserve and all those good things, but he wants to get the job first, doesn't he? So you would expect him to say that sort of thing. But certainly the Forex market is, it's been driven by the credit market at the moment. This massive rally we saw on Monday, on Tuesday when everything came back. In the yield curves, but it is September and it's notoriously volatile. But everybody's back, or the volumes are gradually improved this week, and we get certainly back to normal. Certainly today, tomorrow, and into next week. I think that. normal. So we just go to the higher time frame. You can see the euro dollar's down today, and we haven't recovered. See, as far as euros concerned, we haven't recovered from that significant Monday sell-off as we started September. So upside remains the big round number 117. Downside remains 116, and we've been in this channel for the most of August and most of the summer, to be honest. So if direction was euro dollar, um, as a channel, selling at the top, buying at the bottom. And we're at 116.35 at the moment, closer to the bottom than the top. So will the dollar continue to hold its gains? Elsewhere, dollar again, as we said earlier, 148.50. Again, rather channel bound for August and into September, but the dollar somewhat on the front foot. Technically, the big round 150 still looks a step too far. We're at 148.50 has been the August cap since the sell-off from last non-farm payroll. We'll see what happens tomorrow if we actually break the bottom of this channel. Sterling 134.25 at the moment. Again, the key 135 gave way on Monday. On Tuesday when the US came back. Looked like we were actually starting to tick back up and heading for 136. That wasn't going to go on. Huge engulfing candle on Tuesday. Bounced a bit yesterday. Didn't take back over the 50% level of Tuesday's sell-off. So weakness, and we still need to break 134.60 if cable's going to move to the upside. Downside as initial support is the big round 134. And those two lows yesterday, we went into 133.35. That worry against sterling may have cooled, or looks like it's cooled a wee bit today. 134 is the big support for sterling as we go forward. Aussie 65.15, so it's still pivoting through this key top 65 level this week. And it's our support area, and it's above its 20-day moving average, although week on Tuesday, bounced back yesterday, didn't get to last week's highs, and so slipping again today. So dollars, I'd say, relatively on the front foot, somewhat against the major crosses today. Elsewhere, I'll quickly run through these. Crypto, let's do them from the top down. Crypto, 110,700 on Bitcoin. So that multi-level test down into 107 last week and again this week has held. Remember, we were talking about 105, 106 zone. We haven't actually got that low yet to test the bigger support area. 100 down here. So equally, we can't recover the key pivot area around through 112. So we remain relatively weak, but yesterday's rally has been sold off today, Wednesday's rally. So we couldn't break the 20-day moving average there on Bitcoin yesterday, so that's one to watch. So we look to the downside potentially, or a break of the 112,500 level now to take us higher on Bitcoin. Where else was I? So indices, we took a long position this morning. My system is sort of triggering on the rejection of the 50-day moving average. Here at the end of August, we went in to test the zone on Tuesday's sell-off. Let's see that right now. Tuesday's sell-off, big rejection of the 50-day. So we've gone long this morning here as we play through the 20 days. So it's sideways action certainly. But we'd like to see that above 23,700 for a move back to new all-time highs on the Nasdaq. But it was enough to take us in on that this morning on the 4-hour time frame. It's the daily time frame, the 4-hour time frame is the one we entered on here as it moved through and confirmed the 50 period when we got in here this morning. Long Nasdaq 100 technical, just purely on technicals. Elsewhere, the DAX 23,700, so the 24,000 for the DAX is well behind us. Um, we went into this 23,500 level 1, 2, 3, 4, 5 days, 6 days, and we've rallied from that. So the support we've had early in the week, 24,000 gave way very quickly, but 500 points was on the table, taken off. Thank you very much. And we're ticking back up, but again, the 20 period here on the 4 hours at 23,700. Daily time frame still looks a bit weaker, as you might expect following Tuesday's sell-off. And there's the 24,000 level, looks a long way away from where we are at the moment. But we're having an update today from yesterday's pitch below 23,000, so clearly buys at 23,500 on the DAX, and that next little low we had at the beginning of August at 23,400 is yet to be tested in this current down leg, but certainly still on the higher time frame, the daily time frame, the DAX remains to the down side. Metals, gold. Gold, we've been trailing this long. We ran the stop loss right up behind us this morning or yesterday, and that's been spiked out this morning on a move lower. But we are still at 3,545, so significantly over 3,500 over the last few days. So gold remains very much asset in demand. The futures market still holds over 3,600. This is the gold dollar derivative at 3,000, spot market at 3,545. So, yeah, nice old rally to be part of that.
In recent weeks, we had too much increase in the gold and silver ETFs. That's also supporting the idea of the higher prices. And we thought that when sometimes we have some increase in the US dollar at the same time, we see that the gold price also increasing. I think with the ongoing condition that we have right now, what I was talking about earlier about the trade balance in an export and import, I was thinking that probably the less export in some countries that they are like, for example, the countries like Turkey, like Russia, like China, these countries, India, these countries, they like too much to buy and invest in a gold. And when we have a less export in these countries and some ongoing geopolitical tensions that may affect their economy, these countries, they are getting too much more interested in buying the gold. That's why I think that still we can still continue our bets on the gold price. I mean, I don't think that the gold and the silver should be or will be stopped around this area. What do you think? Do you think that can they continue higher than these prices?
Absolutely, yeah. I'm one. Don't overthink it too much. I'm a trend following guy, so this is
Yeah,
clearly a first entry, and we went to new highs and it just rallied away. I mean, interesting. We've seen. I mean, this week we've seen. Xi with his military display, with Putin next to him, with Kim Jong Un next to him. The alternative power regime in Asia in particular, and certainly standing up against the West as they see it. So all of these parties, all of those areas we mentioned, Russia and other, they see the benefit of having big gold bullion assets in their reserves,
yeah,
and moving away from the dollar. I mean, there was no talk of that at this Xi meeting. And Modi was there as well. Big buyer of Russian oil and continuing to do
yeah.
so. So, the Americans have slammed tariffs on them. Trump overnight,
India.
Trump overnight said, he was disappointed that America was never mentioned in his meeting of the call them interesting parties, but it was very much a
It's
strange
a
collection
yeah, strange in itself. That,
of
especially after 45 minutes, a private conversation between the Putin and Indian president. I forgot the name. In Putin's private car. So they just so many news that came out. What's going? I mean, so many kids actually they came out that what they were talking in that 45 minutes, while the other leaders they were waiting outside for them to come out and continue the show. They were talking for 5 minutes inside the car and let all the others wait. And seeing the North Korean leader in front line, it was increasing the geopolitical tensions, and probably that can also be the other reason for the people to say, okay, guys, let's go and buy the gold and silver, then buy the political shows. You know, they can trust on the gold more probably than political shows.
Yeah, yeah. I mean, yeah, certainly. I mean, I was expecting profit taking at 3,500 on the planning of this. But obviously, we've shaken out over the last 3 or 4 hours as that meetings have ended. I think that's not a coincidence. It's not coincidental that we've had this move back down
Yeah,
in the gold price as the long end of the yield curve, the 30 years have cooled off as well over the last day or so, or over the last day, in fact, you can see here. So, but yeah, gold remains very much big. There was no chatter about Taiwan. Taiwan did issue their statement about the meeting, but yeah, I mean things could really. That is really the black swan event, isn't it? Something China decides they're feeling emboldened enough with what Putin's achieved in Ukraine, which what he looks like he's achieved, to do something with Taiwan. So again, this massive headlong rush we've been into the world of AI, all those chips still vast, 90% I think still of all those manufactured chips come out of Taiwan. TMSC is the big producer, so things could really get upended very quickly if there's any further saber rattling or any news from China. But I think China, my take of it so far is, Xi is a much quite a very very shrewd politician. Uh, um, Putin's a very good politician as well, but a bit more emboldened. And I don't think I think Xi is a bit smarter. And, they always think much more long term. The Chinese mentality, and remember, they are still a communist state.
yeah,
Putin embraces elections, even though he's in control of them. Yeah, I think the way he's played, I think he's seen what's happened with Ukraine and Russia, succeeding, but being seen to be successful. But I don't think it's going to be enough to Xi into doing anything with Taiwan. But who knows? Who knows? What will happen? And God knows what will happen to the gold price if that's the case. $5,000 an ounce easily.
yeah.
But anyway, Thursday we still got later today. We've still got these services PMIs data in the next hour. I'm not gonna bore you and hang around for another hour about this, guys. If anybody's got anything they want to add, any particular asset they want to add and have a trade on, for us to have a look at, let us know. Other than that, I'm going to wrap this up now. I need to go and get some lunch actually. I'm eating. I'll eat properly. But yeah, so just to recap today's data, ADP non-farm payroll employment change. The private payrolls company ADP have recorded for August 54,000 gain from an expected 73,000 pound gain. So it's a miss. Last month was ticked up by 2,000 to 106,000. Again, another sign of perhaps the weakness of the jobs market. However, the caveat remains: it's the August data. It's always a bit messy. It's one of the most unreliable data points of the entire year. Half an hour later, we then had the continuing claims coming in better than expected, 1.9 million. The weekly claims a few ticks higher at 237,000, but still in showing the resilience of the jobs market. So clearly, it looks like this narrative that firms are not shedding labour, but they're not taking labour on either. So let's all see what that shows us tomorrow in the non-farm payroll earnings numbers, in particular the participation rate. As I said, obviously the headline will be the one that grabs it. But as Aurora said earlier, they don't ignore the supporting data. Here, as you can see here, productivity up to 3.3%, costs up only 1%. So this participation rate, those that have still got jobs are producing more. So things are, hence we're in balance, which is what the Fed's sort of been saying. So we can justify a cut in September, possibly another one to come. The market is still, the consensus still is another, it is 50 basis point cuts for the end of the year still. So whether it comes in October or December, we'll see. But the impact of the tariffs might suddenly spike up, and that is the big elephant in the room. We're only really just into the first few weeks, or probably could argue 3 to 4 weeks of tariff impacts. How much can businesses absorb that before they start passing it on to the consumer in the US, or will they? That's the unknown still. Anyway, good to have you, Aurora, again.
Yeah, thank you so much for your time too.
See everyone tomorrow.
Thanks for having me.
Payroll tomorrow. But before that, we got these services PMI data out of the US. Relatively good. And I didn't actually talk about it, but earlier today, the European ones have been okay. The construction ones and the services ones yesterday were okay as well, better than expected. The UK ones were surprisingly strong at 54 and 53, respectively. So, yeah, let's see where we go from here. Okay, take care, everyone. Nice to meet you all.
Yeah.
Be good.
Have a good time. Enjoy your trades.
All the best. Thanks, sir.